So in this tutorial I'm going to share on how to find bias in the higher time frames using the market structure for lower time frames. So assuming I have a 15-minute chart that looks like this, so price is forming higher highs and higher lows as that, right? Let's get it to this point here. Yeah, so let's maybe add another higher high, and then for that day price maybe closes at around this point. Okay, so you realize that assuming this was the opening price and this is the closing price, so what has happened here is price has formed an open low high close. So this let me just label it, so this being the open make it big, so open, and then make it also big like this, and then this becomes the low, and then this becomes the high, right? And then this becomes the close. This level here becomes the close. So this is a typical example of open low high close for the formation of a bullish candle, but now this is a bullish market structure. So I can make it dark color so that it matches the typical candle colors. Then now the new day opens, it opens at around, let me just minimize this kidogo, then bring this right here. So a new day opens right here like that, and then price forms a short-term bullish structure like that, and then gives us a bearish move like that. So let me just remove this first like that, and then now then we have a bearish market structure like that, and then maybe price closes like that. So the moment price closes like that, and now we want to have a bearish color because these are a short-term bearish candle. So I want to show you how this is a typical CRT model, how it forms in the lower time frames as price is moving. So for this to be a valid change, or to be a valid change in bias for this day, like here, it was a bearish day, assuming this is Monday and this is Tuesday. Okay, so you'll have price sweeping this high, and Mesawa, I'm not on MT5, so price sweeping this high. Let me give it a different color like that. So this high, which is the previous day's high. Okay, so this high here is the previous day's high. I'm using the 15, let me assume this is the 15-minute time frame, but with the daily candle in mind. Okay, now as price is sweeping this, also the second confluence that you need to have is price giving you tapping into an area of value in the higher time frames. So you realize that this can be anything, can be a fair value gap, can be an order block, a breaker block, can be an inverted fair value gap. So I primarily love using fair value gaps or inverted fair value gaps. So this becomes now your second confluence that price has given, second confluence that price may change direction, and then it gives you a break of structure. Let me copy this, a break of structure or a market structure shift right here. You can see this swing low right here, so a market structure shift right there. So now for this day again, this becomes the open open, right, and then price forms a high of the day. Let me move that back. This becomes the high. Sorry, I'm using a design software. And then this becomes a low, and then this becomes close. So this is a typical open, high, low, close for the formation of a bearish candle. So I want to show you what now this translates to in the higher time frame. So for example, for the previous day, price opened here, then came down and then went up, okay, then closed. So in the higher time frames, no, let me finish first with this other one. So before you do that, let's just complete this other part now. So this is a typical example of determining a bearish bias, because number one, the previous day's high has been swept. Number two, price has tapped into a higher time frame key level, which is this rectangle here. And then number three, price has given you a market structure shift. So the next day, now you want to trade, maybe this is Monday, this is Tuesday. The next day, what do you want to see? You want to see price opening, which tool? Price opening like that, and then forming a short-term bullish. Let me remove that short-term bullish structure, and then remove that as well, and then bearish structure like that. You can see that. So and then maybe price would close, no, let's take it a bit lower, then the price would close maybe somewhere there. So if you have that, why is it too small? 3, yeah. So if you have that, now this is also another typical example of a bearish bias. So how do you know it's a bearish bias? Because price opens right here and then comes up, and the way we want to confirm that this is a price giving us a bearish bias is it opens, forms a short-term high, a short-term bullish structure, and then maybe taps into, taps into a higher time frame key area. Just use this as well, and opacity 0. Which color did I use? So this short-term structure can be this can be a 15-minute fair value gap. Now then price drops low to give us this a market structure shift or a break of structure. It can be a break of structure, it can be a market structure shift. So at this point, the moment you have this bearish market structure shift, now you have our confirmations. Number one, price has opened, formed a short-term structure, bullish structure, tapped into a higher time frame key level, and then the second confluence is price has given us a break of structure or a market structure shift to the downside like that. So this now becomes a bearish day because of this close here. So this now being a 15-minute time frame, you are going to look for sell opportunities during the formation of this candle. So at this point, can I show you how now this looks like in the higher time frame, assuming this is the 15-minute time frame? Okay, this is a 15-minute time frame, but now we are using this with the daily candlestick in mind. So how does this daily candlestick form? Let me just, this was the close, and this was the low, and this was the this was the high of the day, and this is opening price right here. So how does this look like in the higher time frame? So this bullish structure here, how it looks like is, you see price opened here, okay, and then dropped. So let me use another bullish candle, but this time you'll have it maybe at 50. So that is now the daily candle forming like that. So price opens here, right here, and then drops to form this low, and then goes up like that. So from there goes up like this, up to this high, and then drops to form this close right here. So this close is now where the day has closed. So what about the high and the low? Those become the wicks of the day. So you can see this become the let me use another rectangle. You can see this low here, as price was going low, it gave us that low, and that becomes the wick of that day. So that is the lower wick, like that. Okay, remove that. So this becomes the lower wick of that day, and then here, right here, price went up and then came to close here. So this becomes the higher wick of this day. So like that. So that becomes the daily candle. So if you compress this entire structure into the daily candle like this, you realize this was a bullish candle in the daily time frame, like that. So now this one has been compressed into the daily candle like that. So you realize this was a bullish day. So this was a bullish day. So now I can increase the opacity to 100 and show you that now this was a bullish candle. So that is how you observe the open, low, high, close for the formation of a bullish candle. Now since the next day opens right here, it's taking a bit long. So since the next day opens right here, we can use the same structure again. So the day let me use red this time. So the day opens right here, around here, and then goes up to form this high of the day, and then drops to form this low right here of the day, and then closes around here, which is right here. So this becomes a short term, I mean a candle, a daily bearish candle. Okay, so what about the wicks? The wicks now are these highs and lows. So from here up to here becomes the lower wick. The lower wick can be around here. Let me just stretch it out, stretch it out so that you guys can see how that is panning out. So that becomes the lower wick up to here, and then this becomes the higher wick up to here. Okay, so that is now the concept of open, high, low, close for the formation of a bearish daily candle. So this information has been compressed. Let me reduce the opacity of those three to 50. This 15-minute market structure has been compressed into one big daily candle. So if you compress that, you realize that this now is the daily candle. So move that there and move this here, and increase opacity, and you see that this is the formation of the daily candle. So move it next to this like that, and what do you realize? This was a typical CRT model. So candle 1, candle 2, and this is the daily candle now, but we are compressing that information to the lower, I mean to the into a single daily candle. So now the next day is now you are taking a trade on this day. So you realize price opens here, and now using the same concept, price opens. Let me use another color again. Price opens right here, forms a high to give us a wick, and then drops up to this level right here. 50 to give this low here, and then moves up to this point to close at this point. So, and then you are asking, what about the wicks? The wicks are now these lows and these highs. So we can form now those wicks like this. 50 So this is the wick for the high, and this becomes the wick for the low right here, 50. So now this is this entire 15-minute structure compressed into a single daily candle. So if you let me compress this first. So compress this like that, and that becomes this becomes your daily candle for this price. So how you are determining this bias is you determined where price first opened and then gave you a high of the day, and then you started looking for sales. So during the formation of this daily candle, you are actually looking for sales in the lower time frame. And as I had said, this might be a higher time frame. A lower time frame area of interest can be a fair value gap, can be what, inverted fair value gap, order block, whatever you choose to use. But you can see this wick taps into it and then comes down. So the moment the formation of this wick has been done, that's now when you start looking for sell. Sorry, I was on a call. Now I'm back. So that was the entire 15-minute structure compressed into one daily candle. So increase the opacity of this and place it next to let me delete this and delete this, delete this and this. And now that is a very typical CRT model presented to you, but now this time I'm using the open high low close concept and how to determine bias using the various conferences that I've shared. So as simple as that. I'm hoping you've learned something. Yeah, so the next one I will talk about in case there is no such activity, this was still a bullish candle. No, I mean this was a bullish candle and this was also a bullish candle, and you wanted to participate in maybe trading this bullish candle upwards. It is a trend continuation. How do you participate in that? So that is now what we'll talk about next. And then yeah, so stay tuned and make sure you comment, share your opinions, or also you can subscribe as well.